had a lot of calls and emails asking me how and where I get the tick value, the one I multiplied the ticks with. So let me show you where you can find the tick value for futures currencies and other futures contracts. You go to Google and you type in barchart.com. You go to futures, you go to contract specifications. Here's the tick value for US dollar, here's the tick value for the British pound, here's the tick value for the Canadian dollar, here's the tick value for the Japanese yen, here's the tick value for the Swiss franc, here's the euro, here's the Australian dollar, the peso, and the New Zealand dollar. You can also see here, you can get the rest of them as well for any market. There's the tick values. Also, if you go down to Google and you type in futures contract specifications, you can see the bar chart is the first one to come up, but you can also see there's trading charts and US futures and O'Brien. Just about anybody who deals in futures will have a contract specifications for you. Good day, traders. This is Roger Scott from Market Geeks with another video tutorial for you today. Yesterday, I introduced you to currency futures contracts and how to calculate them using basic tick values. Today, I will show you how to use dual average crossovers to trade either futures or Forex. Before I begin, I'd like to remind you to subscribe to our video channel. And don't forget to visit MarketGeeks.com for your free trading report. The best type of indicators to apply to currency markets are trend following and momentum indicators. The moving average is one of the oldest and most often used indicators for trend following markets. As we previously discussed, there are different types of moving averages and moreover different ways to use moving averages. The simple moving average is the most basic type of moving average. The sole purpose is to add all the prices within a specified range and divide them by the same number. This creates a very balanced average of moving average prices across the board. The 50-day simple moving average is the most often used moving average by fund managers to determine if stocks are trending up or down. The 200-day simple moving average is another favorite indicator. It is often used by market analysts to determine if stock market index is long-term uptrend or in a long-term downtrend. The simple moving average is not used very often for short-term market swings. The second most popular indicator for trading currency futures as well as other quick-moving markets is the exponential moving average, EMA for short. There's a big difference between the simple moving average and the exponential moving average. The simple moving average gives equal weight to all prices, while the exponential moving average puts substantially more weight on the more recent prices. This makes the exponential moving average more dynamic and better suited for short-term price swings. You can see in this example how the exponential moving average reacts quicker to price swings than a simple moving average. The dual exponential moving average sounds complicated, but it's just another way of using two EMAs of different lengths together at the same time. One EMA measures the intermediate trend, and the other EMA measures the short-term trend. When the short-term trend crosses above the longer-term trend, it signals that the short-term direction of the market and the intermediate direction of the market are moving in the same direction. This provides a long entry opportunity. After testing dozens of combinations, I found that using the 18 bar for the intermediate term EMA and using the 9 bar for the short-term EMA produces the most consistent results across the currency sectors for swing trading currencies, futures contracts, as well as cash currency contracts. You can see in this example how the short-term trend resolves in the direction of the short-term trend. The short-term EMA crosses above the intermediate term EMA and the market rallies strongly in the same direction, moving quickly upwards. In this example, you can see how the intermediate trend is moving downwards and the short-term EMA crosses down and begins accelerating down quicker than the intermediate EMA. Notice how the market begins moving down rather quickly after the crossover takes place. Waiting for the first bar to trade completely below both moving averages would be the initial buy signal. Notice how long the dual moving average kept you in the trade without crossing back up. It takes patience to stay in the market this long, but it's worth it in the end. Currency contracts respond well to trend following indicators. The EMA is one of the best indicators for trading currency futures as well as cash Forex contracts. Because the EMA is very responsive to short-term price swings, using EMA crossovers tend to capture the quick changes in the short-term and immediate direction of the trend. The 18-day or bar and the 9-day or bar EMA have been backtested on several currencies over the last 20 years to produce the best results for short-term and swing trading markets. Thanks for joining us for today's trading tutorial. Don't forget to visit MarketGeeks.com for your free swing trading report. Wishing you all the best in your trading.